If you are a real estate investor and you want out, I want to tell you about a way to sell your property, preserve your wealth, defer your taxes, and enjoy a passive mailbox income instead. Get out of the rat race of active management where you are on call to your tenant. In the next 48 minutes, we will tell you how to do just that. Well, thanks for tuning in to the 1031 show. Our show is all about financial planning for real estate investors. This often involves something called a 1031 exchange. This is not a show about doing fix and flips or buying real estate with no money down. It's specifically for real estate investors and financial planning for those real estate investors. So let's give a quick disclosure here. Nothing contained or referenced in the presentation is a solicitation for the offer or sale of any particular securities, product, or service. Consult a competent financial, legal, or tax professional before making any financial decisions or taking any action on topics you hear on our show today. So that gets all the official stuff out of the way. My name's Wally Smith. I'm a financial planner with Ridgegate Financial and Impact 1031. And I'm in Denver, Colorado. My guest on the show today is Rich Arnitz down in Scottsdale. Hey, Rich.
Good afternoon, Wally. How are you?
I'm pretty well. Now, rumor had it that you were slaving away out on a project around the house, and it's almost 100 degrees.
It is almost 100 degrees. We're in the high 90s here, but we are, given another week, we'll probably be in the triple digits here.
Well, then that's when the agreement kicks in with your wife that you don't have to work outside until November, right?
That's exactly it. That's exactly it.
I'm good with that. You know, we talk about a lot of stuff about for real estate investors. Roughly 2/3 of the real estate in the country, the rental stock, if you will, is owned by baby boomers. And baby boomers are generally looking to enjoy life less or more, enjoy their property, work on the property a little bit less, perhaps. And that's really what the show is all about. There are solutions that, as we said in the lead-in, that can help you to sell your property, preserve the wealth, defer the taxes, and really enjoy mailbox income. So that's what this show is all about. Every week we have several people who call in and say, did I hear you right? I can sell my real estate and not have to pay the taxes yet? That's really the heart of what the 1031 allows us to do. So, Rich, why don't you kind of give us a brief primer on what a 1031 exchange is?
Yeah, the term 1031 exchange is defined under Section 1031 of the IRS Code. And to put it simply, it's a strategy that allows an investor to defer paying capital gain taxes on an investment property when it's sold, as long as another like-kind property is purchased with the profits gained by the sale of the first property.
Okay, so let's unpack that for a minute. Defer taxes. They don't get out of paying the taxes themselves, right?
That's correct.
So they defer it, and if they ultimately were to sell the property finally and not go into more property, not do a 1031 exchange, then they would have to pay the taxes.
They would, exactly.
Okay. Now, there's a way to get out of that, right?
There is. You can do what they call a 1031 exchange.
And if you do one of those and keep doing one of those, let's say you had a farmer, one of the rules about how the 1031s came around was a situation where you had a farmer back in the 1920s or 30s who had a cornfield and he wanted to trade for the bean field next door, but he didn't want to have to sell and pay capital gains. So he's really just exchanging the property instead. That was fine. No taxes due at that point. And that's really where this whole thing came from.
Yes, that's exactly right. We get a lot of questions from investors to say, how many times can you do a 1031? And it's really unlimited. There's no limit on how many times you can do a 1031 exchange. The common terminology is they say you can swap till you drop. So you can roll over the gain from one piece of an investment or real estate to another, and then you can continue to do that exchange once that other property is sold, and let's say you have another gain. So we have many clients here at Ridgegate Financial that we've worked with that have done multiple exchanges as well.
So, for anybody who are real estate investors, most of them have heard about a 1031. They're frequently a little bit nervous about them because they've heard there are a lot of requirements and rules, and they are, but we help you navigate that. If you'd like to chat about 1031 exchanges, your own real estate portfolio, give us a call at 303-GET-1031. That's 303-438-1031. We've also prepared for our listeners today a guide that we will send out to you at no charge. And just text the word guide to 303-438-1031, and we'll be happy to send that out to you. To put it in terms that a lot of folks will understand, maybe more with stocks and bonds, if 10 years ago when Jim Cramer was screaming about buying Amazon at $60 or $80 because it was going to go to $600, if you bought it for $100 and it went to $600 and you sold it, you'd have a $500 profit, the $500 capital gain. You would have held it for several years, and that would have been a long-term capital gain. Same thing with real estate. Now, if you had done that and sold it at $600, you'd be kicking yourself because it's at about $2,500 today. But here's the thing. If before you sold it, you passed away, and your children inherited that stock, then you get what's called a step up in basis. They could inherit that $600 stock at the time, sell it, and not have to pay any capital gains taxes on it. So that's really the same rule. That's the step up in basis that the 1031 exchange preserves. It's one of the strongest wealth building tools in the that the IRS allows for in the code. Rich, as far as 1031s, why are people nervous about them? I know they're scared about a bunch of different rules, but they're really not that hard to work through, are they?
They're really not. And I think a lot of it has to do with just the uncertainty of not knowing what a 1031 exchange is. There are a couple time requirements on doing a 1031 exchange, and investors need to need to know about this. The very first one, I think that's the most important, is the 45-day identification period, meaning that the taxpayer must identify potential replacement properties to do the exchange within 45 days, the date of the sale.
I think there may even be one requirement before that.
There is. So the requirement before that is that when you sell your property, you cannot take possessions of the funds. It has to go to a accommodator or what they call a QI, qualified intermediary. It's almost like an escrow agent. And they have to hold the funds for you in trust until you actually select your property and close on your property to do the next exchange.
Now, we are not a qualified intermediary. We are a financial planning and securities firm, but we do work with a lot of them, and we do recommend different ones. It's interesting, that is not a regulated business. You could have any Joe Blow off the street hang his shingle out and put up a website and say, hey, I'm a qualified intermediary.
Yeah, so it's important. It's important that you work with the largest out there. And at Ridgegate Financial, we refer them to the two largest out there in the United States, two largest carriers that are tied to publicly traded, very large escrow companies, title companies. And I would strongly recommend investors, when they're considering selecting a QI, to do their research.
Yeah, you really want to work with the best. So the first requirement is decide if you're going to do a 1031 before you close on the sale of your property. Unfortunately, I've had folks call me that said, hey, we heard the radio show. That's fantastic. We just sold a property 3 months ago. How do we do that 1031 exchange thing? Can't do it. Out of luck. Have to do that. Now, it's also occasionally you'll have someone call, a day or two before, and they can set it up. That's fine. It does not take that long to get the intermediary involved. As far as the dates, so the first date is get the intermediary involved before the sale, because they will represent you at the close. They will actually close on the property and take custodial receipt of those funds. After that, you've got 45 days after the close And that's what's called your identification window. Now, you said something else at the beginning, and maybe we'll come back to that after we take a quick break here. But I really want to talk about what is like kind. When somebody's got a duplex or a fourplex, or maybe it's the building that they own that they had their dental practice or their plumbing business in, that doesn't mean they have to go out and find another one like that. So there's a lot, and really they shouldn't. That's part of what we help, is putting together a diversified portfolio. So when we come back, let's talk about like-kind exchanges, the rest of the deadlines, and what sometimes can make a 1031 blow up. We've got a solution for the worst problem that happens with 1031, so it won't happen to you. This is Wally Smith and Rich Arnitz with Ridgegate Financial, Impact 1031, and we will be back shortly. Well, we're back. This is Wally Smith and Rich Arnitz with Ridgegate Financial and Impact 1031. You're listening to the 1031 show. Everything about 1031 exchanges for real estate investors, that's what we're about, financial planning for real estate investors. Before we took a break, Rich, we were talking about like-kind exchanges and some of the things that scare people about 1031s. But first of all, like-kind. Now, I used a reference earlier of somebody swapping a cornfield for a bean field. Okay, that's like-kind. Obviously, they're both farming fields. But if I own a retail shop where I run my dental practice, or if I have a blue duplex with a red front door, it doesn't mean I have to exchange it for another blue duplex with a red front door.
That's correct. To qualify for Section 1031 of the IRS code, the properties exchanged must be held for use of a trade or a business or for investments. And the nice thing about it is it's general real estate. So you could have your dental office, or you can own a retail building where you run a franchise out, and you can sell that, and you can later purchase self-storage, commercial office, a healthcare asset, multifamily, a variety of different assets. And that's something that we could bring to the table for these investors when we sit down with them and do a asset allocation model for them.
So give you a couple examples. Of course, we never name names, but a couple of anecdotes of some really wonderful recent clients we've been working with for several months. One of them had 4 single-family homes. And those single-family homes they'd had for somewhere between 5 and 15 years. They'd had a lot of appreciation. They were having to manage it. They had a couple of tenants that were knuckleheads, and they were basically tired of that. The kids finally graduated from college, and it's time to be retired. So what we were able to do is take 4 properties that were all in the same metropolitan area, that were all single-family homes, and we diversified. So we diversified into first of all, we diversified across several different sponsors, people who put together the structure of the deal. And I want to expand on that in a little bit, Rich. But we basically got this from a very highly appreciated, maybe overpriced market in Denver. And we're able to spread that out and have some of it be in a property in Tennessee, some of it in a property down in Texas, some of it down in another one in Georgia. But from that, we've diversified it geographically. We have some multifamily home apartment buildings in there that they own a part of them. And this is all in the Delaware Statutory Trust model. So we have that. We have some medical office building, some storage facilities. So now they are spread out about the type of product that they own. But for them to do that and go out, they can't go out and buy a whole storage facility. So how is it, Rich, how does it work that they're able to buy a fractional share or a piece or a part of these complexes?
Yeah, great question. And just to go back to the client that you're talking about, we were able to diversify the client by real estate assets, by state within multiple states instead of having it all in one state, and also give them a higher level of monthly income than they were earning prior. which I think is important as well when you look at the diversification as well. So how we're able to do that is what they call a Delaware statutory trust. And that is, it permits investors to come in. It's a security. So it is vented by FINRA, follows the certain rules with the SEC and professionals out there in writing this as a security document. But it permits fractional ownership, where multiple investors can share ownership in a single property or a portfolio of properties, which qualify for them as their 1031 exchange.
Okay. So a sponsor, now when we say sponsor, that's not like Jim or Ralph. These are, just some random guy. These are actually very
institutional companies,
experienced,
these experienced companies that put
large
these programs together in a security to help individual investors upgrade their properties and do it in exchange.
And so they are large clients, or large sponsors rather. They're big companies. I mean, we can name a few of them, like Inland Corporation, Cantor Fitzgerald. I mean, Cantor Fitzgerald was unfortunately known as a firm who lost quite a few people on the top of the World Trade Center in the top floor, I think 105th floor office. And the amazing thing is what the president of the company did for those families. Good people, good companies. Right now, there are anywhere from 30 to 40 different sponsors out there at any one time. We're comfortable dealing with somewhere 7, 8, 9 of them, about in that range. There are a lot of them that either haven't been around, aren't experienced enough, or for one reason or another, that we wouldn't choose to work with them with our clients' hard-earned money. But you want to be working with the right sponsor. And first and foremost, it has to be a good investment. You don't do it for the tax benefits, which are great. First and foremost, it has to be a good investment and it has to be managed well. And then we look at the quality of the income, the people it's being leased out to. So explain a little bit about that. Let's say that you have a medical office. Let's say there's a Delaware statutory trust. Somebody sells their duplex. They take the money. They want to roll it into a 1031 exchange. And they're going to end up in let's say, a medical office or a drugstore DST that owns medical offices and drugstores. How does that work? Who owns it? Who manages it? How does the money flow? Can you explain that a little bit?
I can, yeah. So as I mentioned earlier, these DSTs, they're securities. They're prepackaged. So the real estate is already purchased, the debt is already placed on the property, and you're buying fractional ownership or percentage ownership into that asset itself. And they're all income producing assets. So these aren't developments. These aren't in 5 or 10 years, we hope to actually sign a tenant. You can see and review and do all your underwriting, reviewing of the document, which gives the advantage of people in a 1031, the advantage of certainty of close, because you can review the security and the investment totality versus trying to close on an investment property yourself and not going into a DST on it as well. So the solution here is it's been vetted not only by the regulatory agencies, the FINRA and SEC, but also professionals, commercial real estate professionals in the industry putting the packet together as well. We look at this as a real estate investment, number 2. And I think it's important that you look at the advantages of a DST. It allows you to upgrade your property to more of a commercial grade property that you probably couldn't afford individually with because you're buying a fractional ownership now versus you going out and trying to buy a large multifamily or large industrial property. So that allows you to do that as well. And then the third thing that a DST allows you to do is allows you to do this as a tax incentive. It allows you to defer your capital gains tax. So we really look at it as a solution. Mm-hmm. For anybody doing a 1031, certainty of close. And I think that is the number one issue that investors come to you with having that understanding of certainty of close within the 45 days of your 1031 exchange.
So we're covering a lot of info here, but let me kind of recap. If you want to sell a property where you've got a lot of profit built up and you want to preserve that wealth for yourself, for your heirs, you'd like to continue getting income, good chance you might even be getting more income from it. You don't want to have to pay the taxes on it now and maybe ever if you keep it in real estate the rest of your life. You want passive income. You don't want to be having to take care of tenants and toilets and trash, the three T's, and really just want to have the mailbox income, have it coming in. That's what you can do. And one of the favorite visuals I have is an old rundown duplex with the weeds kind of overgrown, a for sale sign where one of the screws has come off and is kind of hanging at an angle. The place needs paint. And, somebody's just looking at that like, man, this thing owns me. I don't own it. Well, actually, to swap that property for a share of the big, gleaming, beautiful multifamily apartment building right next door, you can do that. You can do that. You can improve the quality of what you own, get out of active management of it, preserve the wealth for your heirs. And the interesting thing about whether it's an apartment building or whether it is a group of retail outlets, some of the retail outlets that were essential services during this recent health problem have done very, very well. They're guaranteed to be kept open. The government's not going to shut them down because they're essential and they're paying their rent. So ultimately your income comes from being a landlord, but you're not the landlord. You don't have to deal with it. So you are then concerned about how strong are the leases. And so the structure of this investment is such that you have long-term tenants. Sometimes they're government tenants. Sometimes they're medical companies. Sometimes it might be a drugstore chain that has a 10 or 15-year lease. And these are strong companies. Your money is, the success of it isn't dependent on the stock market going up and down, because you look at a big company like CVS or Walgreens, maybe their stock prices go up and down, but they keep paying their rent. I'd rather be the landlord to those companies than own the stock and have the volatility that comes with that. Let's take a break. We'll come back and we can talk a little bit more about some of the sectors and about how you can work with us. Wally Smith, Rich Arnitz with Ridgegate Financial and Impact 1031. We'll be back shortly. All right, we're back. You're listening to the 1031 Show with Wally Smith and Rich Arnitz from Ridgegate Financial and Impact 1031. We are a financial planning company. We do financial planning for all sorts of folks, but this show is focused specifically on real estate investors and 1031 exchanges. It's a broad enough topic and audience that we felt we really wanted to do a specific show just for that. Rich, on the break, we were talking a little bit about certainty of close and what exactly that means. Certainty. You're certain it's going to happen. Close means you're going to get the deal done. So how can that's one of the biggest problems with 1031s. People are worried, can I get it done? If I don't, I'm going to get killed on taxes. How can we allay and mitigate those fears?
It's a great question, and I think that is the number one fear for anybody trying to consider doing selling their investment property and doing a 1031 exchange. So there's really two camps. With a DST structure, as we mentioned, it is a package security where we put the real estate inside, and that is already closed. So it's already purchased, it's already income producing, and you're buying a fractional ownership. So you have certainty of close. There's no underwriting that you need to do. There's no getting approval. There's no getting third-party due diligence out there. It's all been underwritten by professionals, by the SEC, by FINRA, and also our own due diligence that we've done on the property itself.
So let me interject. In a typical 1031, I've sold a duplex and I want to go find something else to put it into. I have to identify it, I have to buy it, and I have to hope that the deal comes together, which could include me getting financing. Even if the financing has been promised, until that deal is done, I may not be able to close on it. Whereas with this structure, think of it as inventory sitting on the shelf. It is ready to go. And if you need $431,800.17 worth of the deal, okay, that's what you buy. It's ready to go. It's certain that you're going to close. That's compared to what?
That's compared to an investor going out and trying to do a third-party underwriting on an investment property themselves during this pandemic, where you're trying to coordinate third-party people, title people, escrow people, and even trying to get loans. We have gotten many 911 1031 calls from investors where they identified a property, they did the due diligence and underwriting, but the banks have pulled their offer sheet and they weren't able to get financing at the last minute. And there's a provision in most of the loan documents out there that investors unfortunately find out about where it's too late.
At the worst time.
It's called the MAC provision. It's material adverse condition, where banks, it's kind of the out provision for banks when they don't feel comfortable in the current environment, current rates, to actually close on that investment, and they pull a MAC provision on you and they pull the offer sheet, and then you have no financing. So we allow, when we say certainty of close, within a DST structure, the financing is already in place on the asset itself.
It's all
you're doing is buying your fractional ownership or the equity portion. And then if you have debt on your existing property that needs to come over, we can take that also as well and match that up perfectly within the DST. So a DST allows you 100% certainty of close. It allows you freedom from management responsibility. It allows you to upgrade your property and diversify not only geographically, but also by the sector of real estate. And at the end of the day, the most important, it allows you to probably generate more income than what you're currently doing with your current investment already.
And that's really a starting point. We will, in a free call, in a free meeting, and we're doing Zoom meetings, we're meeting in the office, whatever is most comfortable for you. We really want you to be comfortable discussing your situation. But what we'll want to do is talk through and just get some basic facts that all come back again to that trademark process of ours, which is purpose and planning and portfolio. What do you need your money to do? If you want your money to last for generations to come, that's great. If you don't have kids or that's not important, you want to leave it to the church or to the Dumb Friends League, then that's a whole nother situation. We have to figure out what you need your money to do. We plan around that, and that we can do in a strategy call. We can talk on the phone and get acquainted. By the way, you can call us at 303-GET-1031. That's 303-438-1031. You could also text the word guide to 303-438-1031. And we'll send you out some information that's a starting point on the whole topic. But what we'll generally want to do is say, when did you buy it? How much did you buy it for? Have you depreciated it? What's it worth now if you were to sell it? And do you have any debt on the property? We find out those things, as well as what is the actual net income. We know what the rent is on your current property. You tell us that. But what is the vacancy reserve? What are the maintenance reserves? What are the taxes? What's the insurance? What are the management costs if you have somebody else managing it? We really want to find out, from a piece of real estate that you own right now, what is the spendable income that you're getting? Because that's what we are trying to replace. And generally, we're very good at that, being able to replace that, and even in a more tax advantaged way. So the certainty of close and the material adverse conditions clause, Rich, that you're talking about, I mean, if somebody bought a property for $200,000, they depreciated it fully, and they've got $1 million value to it now, if they don't get the 1031 done on that, it could cost them $300,000-$400,000 of taxes.
And it could be devastating for a couple. They've worked their entire life to actually build up probably the largest percentage of their net worth, and to write a check for $300,000 to $400,000 to the IRS, it would take another 20 to 25 years to recoup that income. And so what we're trying to do is legacy planning as well, and helping them with that and the ease in the process of doing that. So we can take the anxiety that a lot of people have in doing an exchange and walk them through a very simple process. And at the end, everybody always says, if I knew it was this easy, Wally, I would actually have worked with you long ago so that I could make sure that my kids are taken care of. I have more time now to spend with them from the freedom from the day-to-day management responsibility, and you diversified the assets and you've upgraded the portfolio. So it's a win-win.
Well, and we've, everybody's situation is different. That's why we go through our purpose planning portfolio process to understand. Maybe you have kids, maybe you have a farmland or ranch land. Well, maybe the kids don't have any interest in working that farmland or ranch land. That's one situation. Another might be that, well, I've got oil rights and I've got, not that they're paying much right now, but we've got oil property. Can we use that? What are the assets? It's not all single family homes or duplexes that we're talking about. It's the whole range of any real estate, any real property can benefit from the 1031. Why would somebody want to go with a 1031 into a DST structure instead of, say, doing a 1031 out of a duplex into another duplex, into another property? What are the pros and cons you run into?
Yeah, great question. So I think a few of the benefits that we hear all the time for investors doing a 1031 exchange into a DST structure, number one is no management responsibility. The DST is a single owner and aligns the decision-making on behalf of the owners themselves. So it's being professionally managed by those institutional sponsors we talked about in the earlier show as well. So it's taking an investor from an active manager to a passive manager, and that drives a lot of the people why they actually want to sell their properties, because they're tired of the day-to-day. Number two, I think is another key factor, is that it gives them access to an institutional quality property that they normally could not go out and afford if they're going to do it on their own. Mm-hmm. So this allows them to get a fractional ownership in a large multifamily complex. It allows them to actually own a large a fractional ownership in a medical office building or a distribution warehouse facility as well, or a self-storage facility. So we could take an investor on an exchange and put them in 4 different investments, diversified into 4 different sectors, and give them passive income coming in, mailbox money on a monthly basis, and much higher than what they're currently doing with the day-to-day active management.
So a friend of mine, he's been a planner for about 20 years out in Ohio. I won't name his business, but he has his entire logo and his whole company brand is built around the idea of a swan. And it's he's got his company is branded with a swan. And I think he overdoes it a little bit. He's a great guy and a real leader in our industry. But man, when he has a new client, he sends them wine glasses with swans on them, and a blanket and an eye shade with a swans everywhere and on the front door, and it's etched into the glass in his conference room. I asked him one time, and why the swans? I did. It's not his last name. What was the connection? And what's the swan all about, Rich?
Well, the swan is sleep well at night, and is that correct?
Absolutely. Yeah.
sleep well at night. So basically, it gives an investor on the exchange an opportunity where they have that freedom from that day-to-day management, upgrade it, have it professionally managed. And I think the last thing I wanted to mention, which I think is the big part too, is that it's limited personal liability. The loans on the property themselves are non-recourse to the investor.
Excellent point.
And that the DST is the sole borrower. So, and I think that's critical when you think about that. So you're buying just a percentage interest, and the DST structure itself is the borrower that already has the loan in place. So there's this is all non-recourse. So you can go out from unlimited liability in your small investment property, and you can upgrade to an institutional property and not have any type of personal liability whatsoever.
Well, let's talk about that more in just a moment when we come back from our break. You're listening to the 1031 Show. Welcome back, folks. You're listening to the 1031 Show with Wally Smith and Rich Arnitz. Hey, Rich.
Hey, good afternoon, Wally.
You know, before we took the break, you're talking about the recourse loans, and I really wanted to address that. Some of the investors that we have quite a few properties. I mean, sometimes 20, 30, 40 properties. Most people have several, and I think that's probably typical with the baby boomers, is to have a handful of properties. But what happens when people are approaching retirement, if they have any debt on the property, that if they own the property themselves, debt on a piece of real estate can be scary. Okay. You can have a meltdown in the economy and nobody's paying you rent, and you're not able to be paying your mortgage on that property. So it's not at all uncommon for me to talk to people. What is their purpose as they're approaching retirement? And part of their purpose, or one of their goals, is to say, we want to be completely out of debt. The main reason is because they're afraid of debt. Now, with a Delaware statutory trust, they do a 1031 exchange. By definition, you still have to carry the same debt. You have to have the same amount of debt and go equal and up, both in debt and in value of the property. So is it still a good option for them if they want to be out of debt because they're scared of it?
That's a great question. And I think too, a lot of people surprised when they go into a DST. One of the critical benefits is that the loans are non-recourse to the investors. Meaning that they're not personally responsible for that debt. The DST is the sole borrower, meaning the structure itself that owns the asset is the borrower of that asset. So they can't go after the investors personally in that debt as the debt holder.
Now, one of the things that often comes with debt is leverage, meaning that you are controlling a bigger asset than just the amount of money that you have in the deal. We're getting into the weeds a little bit, but most real estate investors understand depreciation, and they understand that if they put $250,000 into a deal and now they control $1 million asset, they're actually getting the depreciation, the tax write-off off of the $1 million asset against the income it's generating. That can put them in a very favorable tax situation for many, many years. It can be to the point where it offsets any income taxes, for example, that they would be paying from those properties. Now, that's the benefit of having leverage, of having debt on a property. Now, one of the neat things about the Delaware Statutory Trust is you still benefit from that, but you're not on the hook personally for the debt. Can you elaborate on that a little bit?
Yeah, so I think that's one of the critical, and that's one of the benefits of sitting down with Ridgegate Financial in doing the planning, because I think it's so important that a lot of investors take their largest asset and they just go out and think that they have to go out and buy another similar asset that they're exchanging, and they don't sit down with someone like yourself or the team that you've put together in explaining really what they're trying to accomplish at the end of the day. What's their long-term goal? So you do get the benefit of the debt itself without taking the personal responsibility of having that liability personally as an individual with you and your spouse as well. So the benefit of leverage always is you could buy bigger properties. You get the depreciation on it, which shelters the income for probably anywhere from 7 to 10 years with the hold on that property as well. And that generates usually a higher yield as well when you can leverage a property.
Well, and I think that's one reason. I've had people challenge me when I tell them that real estate has built more wealth in the country than stocks. And they say, in general, how can you do that? The stock market goes up 8% a year, 9% a year over the long historical average. And they'll say real estate over the long historical average has gone up maybe 4%. It's a much lower number. But unless you're pretty sophisticated and are very aggressive in what's called a margin account with your stocks, you're not using leverage with the stocks. And even if you do, it's usually only 2-to-1 leverage, meaning if you invest $100,000 in a stock account, first of all, your risk now with leverage is going way up. But if you have a 2-to-1 leverage, that means $100,000 worth of your investment can control $200,000 worth of stock. Well, with real estate, the leverage has been extraordinary, 4, 5 times, 10 times leverage sometimes, but generally with investment real estate, about a 5 times leverage is kind of average as you get into a property. So that's why, even though the stock market, the average stock market has grown faster than the average real estate values, the leverage that comes with real estate has made it hands down a winner as far as the overall gains. Plus, with the debt that you have with in the stock market, you're not using that to depreciate the income that you're getting. It's a whole different, a little bit, you can write off some interest, but the way that the stock market or the way that the real estate market is designed is truly unique. It is a unique investment vehicle, and we actually show you ways to really capitalize that and find a way to preserve that, magnify it now, preserve it as you go forward, but also as you go into retirement, take the personal responsibility for that debt off of your shoulders without closing out the whole deal, still keeping the benefits, but without having that personal recourse.
And it's important to note too that I know that we're talking about leverage, the use of leverage in these DST structures, but there are some DSTs structures out there that are all cash for some investors that don't want any type of debt whatsoever. So they're both levered and unlevered in all different sectors as well.
That's right. And because there is a range of DSTs out there, some have high leverage, no leverage, somewhere in between. Part of what we do with each client is we say, what are we trying to achieve overall? And it is generally a strategy. It may just be one property. It may just be, I've got this one tenant, I've had it, I don't like the property, I don't like what's going on in the neighborhood. We have one of our favorite clients over the last year decided, hey, we're doing great, but we're moving to the East Coast and we want to sever ties with any real estate we have here in Colorado. That was great. We were able to help them out with that step by step, saying, what do we ultimately want to own? We want to have a well-diversified portfolio. And I think that's what I'd like to close out today with is diversification. They wanted to move from having perhaps fully appreciated property here in Colorado to being diversified in other parts of the country and in other market sectors. So Rich, I know you watch this. It's kind of funny. Every day when I turn on my computer, I have a wonderful summary of what's going on in this particular space of alternative investments. And man, you're an early riser. You send those to me at like 4:30 or 5 o'clock in the morning. So I know you watch this stuff every day. What do you see as the trends, the things that have been happening, especially in a post-COVID real estate environment?
Yeah, so I think that and thank you. It's very important that we monitor that and we take that responsibility on over here at Ridgegate with since this pandemic has come about. It has impacted sectors of real estate. So what we look for is, in certain sectors, we look for recession resistant, but not recession proof. Nothing's recession proof. And so the sectors that we currently are strong in is multifamily. I think multifamily plays a big part in a person's allocation as well.
You know, at the beginning of the show, you mentioned that multifamily. I just sorry to interrupt, but I want you to remind again, the multifamily, you think people living in apartments, and people living in apartments may not be able to pay their rent right now because they may be out of work. 30 million people out of work right now. But how is the government helping the owner of that multifamily property?
So that's a great question. So financing on a large investment in multifamily is government agency financing. It's Freddie Mac or Fannie Mae. And one of the benefits that the government has told the landlord is that if you have any tenants during this COVID pandemic episode that cannot pay the rent because they got let go or furloughed, you are not allowed to give them an eviction notice or a late notice, but what you can do is deduct that amount that you were to receive in rent off your mortgage payment. So it's almost like a insurance policy, disruption insurance policy for our investors who invest in those types of properties. We make sure that it's all agency financing, and we look at the occupancy and the strength of the sponsor and the strength of the property manager. But we've had no disruption in the distribution of income off any of the multifamilies that we have placed our investors in.
In fact, I was talking with one of the companies last week. They actually said that this 540 unit complex they have is the strongest performing asset. In spite of COVID, in spite of any of the stuff going on, that's the strongest performing asset that they have as far as rent collections, new leases being signed. So, you know what, we've got about a minute left on the show today. I'd love to spend another hour on this, but one of the takeaways that I get from that is the importance of the sponsors, the importance of having well-managed, well-designed people who nobody's been through this before, but have these sponsors been through the strong sponsors? They've been through turn downs. They've been through 2008. Some of them inland, they were through 1985. I mean, they've been around 50 years. So working with a sponsor who is not shell-shocked by things that happen and being able to say, okay, this is a crisis. How do we manage the crisis? What do we do? And it's been really interesting to watch the range of responses during this COVID crisis from these sponsors. But I think that really emphasizes the point. And, you know, that's one of the things I really appreciate, Rich, about working with you is you personally know the vast majority of these sponsors. You've been working with them for 20 or 30 years. You know, I used to be 30 years ago, I was in the technology industry, and it was interesting. We'd go to the trade shows, all the same people would show up, but they'd be wearing different polo shirts with different logos. And, you know, this one was with that company, and now they're selling for this company. But you've been there, you've seen it, you know these sponsors, you've been such a great asset. I appreciate that in working to help design portfolios that are truly going to deliver what we're trying to deliver for our clients. Folks, we got to go. We will be here next week on the 1031 show. And please, you can send questions in to us. You can visit us online at impact1031.com. You can call us at 303-GET-1031. You can even text the word guide to 303-438-1031. And we will send you out, no obligation, we'll send you out a guide. And perhaps we can get together and talk about your strategy for your own real estate. Until next week, it's Wally Smith and Rich Arnitz.